this is Rob Roy, and welcome to the Elliott Wave Options U.S. Market Update. Well, we got past the big concern, at least in the near term for the markets, and that was whether or not we were going to add additional tariffs to the China imports this weekend. Not only are we not adding new tariffs, we did get a phase one deal that was announced on Friday, agreed upon with the U.S. and China, and that meant no new tariffs and a slight cutback in some of the tariffs. I think a lot of people thought that there would be a little bit more cutbacks on existing tariffs, but at least there was a deal. So now, are we rally on till the end of the year, or does this become a buy the rumor, sell the news type event? Let's take a look at the charts and find out. Now, obviously, you've seen this chart of the S&P 500 a number of times, but I've labeled it, and I wanted to go through a few things here that I thought were very interesting. We talk a lot about Elliott Wave because that's what our primary focus is on, but most people, when they're introduced or learn about Elliott Wave, they learn about the 5-wave patterns, which are those circles with the numbers in it, which is the big 1, 2, 3, 4, and 5 wave patterns. We focus at Elliott Wave Options on the corrective patterns as well. In fact, even more so because, according to Elliott, those are even more reliable. And I think it's fascinating that just in this last Wave 5 segment, we had all three of the corrective patterns. The red line there is labeled with the A, B, C, and that's a zigzag pattern. That's a directional pattern, and you can see it's only 3 waves versus the 5. We also have triangles, which we had a blue triangle there in the move following the A impulse. So in the B correction, we had a what's known as a complex B wave. And then we also had a flat, which is the green dotted lines, which is a sideways move. So we went down with the A, up to the B, and down to the C. So all that stuff was occurring all within a wave 5. All those are tradable patterns if you know how to identify them and what to look for. So it's just fascinating that one wave in the market had all three of those patterns. So let's take a look. I've showed you this before, but let's revisit it here with the zigzag and where we could potentially go from here. In the last recording, we talked about how we'd come down to that 78.6% fib level, and was that going to be enough to follow the rules of testing the previous fib level before going to the next one? And at least to this point, it looks like it may be, because we moved up, came down, hit that 78.6% level right on the low, and have moved higher and had 2 good days on Thursday and Friday to finish the week, and we're well on our way marching towards that 161.8% extension. I think there's still some caution that we may still need at some point in time to come down and test that 61.8% level. As you can tell, I just don't have a tremendous amount of faith in the 78.6% fib level in equities. But nonetheless, you trade the pattern, and so far the pattern is showing us that we're wanting to go higher. I think the beginning of the week is going to be very interesting because of what I mentioned in the intro. Could we have a bit of a buy the rumor, sell the news scenario? In other words, we've been expecting this trade deal. They've been giving us hints that things other than the December 2nd and 3rd, where there was a little scuttlebutt of maybe we should wait till after the election. But other than that, the news has been fairly positive that this was going to happen. So I think the market was pricing it in. Now, the market was expecting maybe a little bit further rollback on the existing tariffs. There was some, but not as much as a lot of people were looking for. Will that actually create some disappointment going into the week, or are we going to continue to move higher? We still have that same dichotomy that I talked about before, where a lot of fund managers have greatly underperformed, and they're going to be chasing performance. And then we also, the other side of the coin is those that have made the money. They're going to be watching very closely. They'll let it ride because they prefer to push the gains out into next year and sell in January and take the taxes in the next year. But if the market does start to reverse and head down, they'll be quick to sell, and that'll exacerbate selling to the downside. But for now, we've broken above. We have to trust the technicals. When we have 2 bars that have broken above that 100% extension, which means by rules, then we should go up. Now, it doesn't mean we're going in a straight line, but we should go up to that 161.8% extension. Looking at the VIX real quick, we have dropped significantly, as you would imagine, over the past 2 trading days, and now we're getting down towards that level of support again. So maybe the market wants to pause just a bit as we move into the beginning of the week. We go back and look at the chart again. Something to always look at for the short term is the moving averages, and we're not really all that overbought according to where we are in the 10-day moving average. So if the market wanted to move up again on Monday, it still has enough ammunition from the overbought, oversold scenario to do so. Interesting with TBT on interest rates. We had an auction, and Rick Santelli on CNBC, if you've ever watched it, he grades the auctions when we are selling off notes. And this week they sold 30-year treasuries, and he gave the auction an A+. And so he said he doesn't remember if he's ever given an A+ before. The bid to cover was 2.67, I think is what he said. And so the 2.67 means there's 2.6 bids for every security that's being offered or every treasury that's being sold. So that means there's a heavy demand. So the higher the bid to cover number, the higher the demand is. So the higher the demand, prices go up, yields and rates go down. And so the takeaway from the fact that it was so well subscribed to, in fact, oversubscribed, more people wanting the treasuries than were available, that seems to think that interest rates will stay to the downside. We still have a pretty good solid level here with the wave 4 right at that Fibonacci level, but if we break that, then we could go much lower down to this previous level around the 22.5 level. The dollar showed a little bit of weakness at the beginning of the trading day on Friday and then recovered to close near the highs of the day, but it's also holding in that level right around the strong Fibonacci level. So all eyes will be obviously on the market to start the week, and I'll certainly be watching to see if we continue to move up towards that 161.8% extension level. Hope you've had a wonderful week. Be back to talk to you again next time. Take care, everybody.